In 1815, one family made more money in a single day than most nations made in a year. Not by working harder, not by getting lucky. They understood something about money that school never taught you, and 200 years later, almost nobody applies it. Today, I'm going to show you exactly how I would take $500 and invest it like a Rothschild, using the same 3 principles that turned one family into the most powerful financial dynasty in modern history. Here's the truth nobody wants to say out loud. The middle class doesn't lose money because they don't save. They lose money because they save at the wrong time, and they buy at the wrong time. They panic when everyone panics. They buy when everyone's already bought. The Rothschilds built one of history's greatest fortunes by doing the exact opposite of what feels natural. And that right there is rule number 1. Everything else in this video builds on it. 1815, the Battle of Waterloo. London doesn't know who won yet, and panic is spreading through the markets like wildfire. British bonds are crashing because everyone assumes Napoleon has won and Britain is finished. Nathan Rothschild's private courier network gets him the real news before the official messengers even arrive back in London. While everyone else is selling in terror, dumping their positions at any price they can get, he starts quietly buying British government bonds at rock-bottom prices, betting on a recovery almost nobody else believes is coming. Now, this story gets exaggerated a lot online. No, he didn't single-handedly crash the market on purpose. And no, there was no secret conspiracy controlling the outcome. But the real lesson survives the myth completely intact. Information and patience beat panic. He wasn't smarter than everyone else standing in that room that day. He was calmer, and he moved while everyone else was acting purely on emotion. Fear is not a strategy. Say that back to yourself the next time your portfolio drops 5% in a week and your hand hovers over the sell button. Here's what most people don't know. Mayor Amschel Rothschild didn't just build one bank in one city and hope for the best. He deliberately sent his 5 sons to 5 different cities: London, Paris, Frankfurt, Vienna, and Naples. Each son ran his own branch, with his own local knowledge, his own relationships, and his own independence from the others. If one country's economy collapsed, went to war, or got hit with sudden instability, the family's wealth didn't collapse with it because it was never sitting in one place to begin with. This is diversification in its rawest, oldest form. Not just the tired advice you've heard 1,000 times, don't put all your eggs in one basket, but something sharper than that. Don't put all your eggs in one basket that's sitting in the same building, in the same city, exposed to the exact same risk at the exact same time. Geographic risk is real, sector risk is real, currency risk is real. And in 2026, most people investing $500 have never once thought about any of it. They put it all into one stock because they saw it trending online for a week, and they call that a strategy. The Rothschild family didn't get rich in one generation, and that's the part people conveniently skip over when they tell this story. They got rich because they thought in generations, not in quarters, not in weeks, and certainly not in whatever's trending on social media this month. Mayor Rothschild is famously, though possibly apocryphally, credited with calling compound interest the 8th wonder of the world. Real quote or not, the family's documented behavior proves the principle either way. Reinvest. Don't touch the gains. Let time do the heavy lifting while you do almost nothing at all. Right now, if you're checking your portfolio every single day, refreshing the app obsessively, watching every red and green tick like it means something, you're doing the exact opposite of what built generational wealth. You're trading like a gambler in a casino, not investing like a dynasty planning for grandchildren you haven't even met yet. Silence and time are the real multipliers here. Nobody in recorded history got rich by watching a chart refresh every 4 minutes. Okay, history lesson over. You didn't come here for a documentary about dead European bankers, however interesting that is. You came here because you have $500 sitting in your account right now. It's 2026, and you actually want to do something productive with it instead of letting it quietly lose value to inflation while you scroll past it every day. You don't need a private courier network in 2026, and you definitely don't need insider access to European royalty or some secret information advantage. What you need is a plan that exists before the fear hits, not one you scramble to invent after it already has. Set aside roughly 40% of that $500, about $200, for a low-cost broad market index fund. Not because it's exciting, it isn't, and it was never designed to be. It won't get you likes or comments on social media. You do it because it's the modern equivalent of buying stability while everyone else is reacting emotionally to headlines they don't fully understand in the first place. Next, diversify like the Rothschild sons actually did, not like the watered-down version of that advice you usually hear. Spread the remaining money across genuinely different sectors or asset types, not 5 versions of the exact same bet dressed up to look different from one another. Take roughly $175 and split it between something like an internationally diversified fund and a small allocation to a completely different asset class. The goal isn't maximum excitement, and it was never supposed to be. The goal is making sure no single event, no single company, and no single country's bad news can wipe out your entire position overnight while you sleep. The The last $125 goes toward the boring long-term play. Something you set up once, automatically reinvest, and then genuinely don't touch for years. Not just months when things get uncomfortable. This is your generational seed money, even if the generation in question is simply future you, 5 or 10 years down the road. It's not a trade. It's not a flip. It's not something you check every morning with your coffee. It's a tree you're planting today that you won't see fully grown for a long time. And that delay isn't a flaw in the plan. It is the entire point of the plan. Quick, honest disclaimer here, because I'd be lying to you otherwise, and I'm not going to do that just to keep the momentum going. None of this is personalized financial advice, and past patterns, Rothschild or otherwise, do not guarantee future results in any market, ever. This is a framework for thinking about risk and patience, not a guaranteed formula for getting rich by next quarter. Anyone online telling you that investing is guaranteed, in either direction, up or down, is almost always trying to sell you something else entirely, and you should be skeptical of that immediately. Here's where roughly 90% of people fail, and it genuinely isn't the investing part, it's the discipline part, every single time. The Rothschilds didn't panic sell during downturns, and they didn't chase hype during booms, even when everyone around them was doing exactly that, loudly and confidently. If your $500 drops to $420 next month, that is not a crisis, and I need you to actually hear that instead of just nodding along. That is a test. It is the exact same test every investor throughout history has faced, in every decade and in every market. The families who built multi-generational wealth passed that test by doing something that sounds simple, but is incredibly hard in practice. Nothing. Just nothing. Can you actually do that? Most people can't, if we're being completely honest with each other right now. They see red numbers on a screen and act on instinct instead of the strategy they promised themselves they'd follow. They sell at the bottom because it feels safer in the moment. Then they buy back in at the top because it finally feels exciting again. 5 years later, they wonder why they have less money than when they started, despite technically doing something with their money the entire time. The families who kept their wealth across generations weren't necessarily smarter investors than everyone else around them. They were simply more patient humans, decade after decade. That's the entire secret. And it's the part almost nobody wants to hear because it isn't flashy enough to build a course, sell a newsletter, or generate a viral headline. Let's zoom out for a second before we wrap this up. Every single rule we've talked about today, buying calm instead of panicking, spreading risk across places instead of concentrating it in one spot, and letting time compound quietly instead of trading constantly out of boredom or anxiety. None of these are complicated ideas. A 12-year-old could understand every one of them in under a minute if you explained them clearly. The difficulty was never the concept itself. The difficulty has always been the discipline required to follow it when your own emotions are screaming at you to do the exact opposite. $500 isn't going to make you a Rothschild, and I want to be completely honest about that instead of overselling it just to get more views. But $500, invested with their discipline instead of your emotions, can become the first brick in something that genuinely outlasts you. They didn't build a fortune overnight. They built a system, a repeatable set of behaviors that was deliberately passed from one generation to the next. And systems, unlike luck, unlike hype, and unlike whatever is trending this week and forgotten next week, actually repeat. If this changed the way you think about your next $500, subscribe right now, because next week I'm breaking down the one investing rule that made the Vanderbilts and then just as completely destroyed them one generation later. Trust me, you do not want to miss that one.